Thanks for joining us today on The Close. I'm Marilla Fernandez. Markets close in 30 minutes. Let's get to the stories we're following out of the BNN Bloomberg newsroom. The Canadian government has asked oil companies to release some reserves. It will be used to support the International Energy Agency's plan to inject 400 million barrels of oil into the market to ease the supply shortage. Ottawa is also in talks with oil sands producers to explore near-term opportunities to boost output. Iran Supreme Leader, the Ayatollah Mojtaba Khamenei, issued his first statement on the war today, supporting the closure of the Strait of Hormuz and saying Iran will keep attacking its Gulf Arab neighbors. The conflict has pushed oil back above $100 US a barrel. Aluminum prices have hit their highest levels of 2022 as that war in the Middle East carries on. Prices have climbed about $3,500 to $3,500 a ton. Supply impacted in the Persian Gulf, which does account for about 9% of global output. And the TSX 175 points down on the day, about 0.5%, sitting today at 32,944 right now. South of the border, also more red. The S&P dropping 1.2% right now. The Dow Jones down 1.25%. And the NASDAQ, a 333-point drop, 1.5%. So Canada's merchandise trade deficit widened to $3.6 billion in January, driven by a drop in auto exports. Now, south of the border, the U.S. trade deficit actually narrowed by more than 25%. Let's start there with Claire Fan. She's senior economist at the Royal Bank of Canada. Claire, thanks for joining us today.
Thanks for having me.
Is this cyclical in any way? Are we producing fewer vehicles right now in parts in Canada?
That is a great question, and I do think that is sort of the starting point into this trade story, which is the fact that, a lot of the deterioration in Canada's trade balance was driven by autos, and the other one was gold. In terms of whether this is going to be cyclical or more structural, well, Statistics Canada kind of framed it as a atypical production disruption or stoppage, really, due to changes in car models. So that implies that this perhaps will be a more seasonal issue as opposed to structural, and we can soon expect some rebounds in the following months.
Okay, so given that scenario, or at least that explanation, it doesn't, from this point, look like it could get worse.
I agree. Yeah, I think so. So the good news there is, if that were to be the case, it does look like at least this wasn't entirely driven by trade and tariffs, which kind of is consistent with what we're observing on the trade front. We've seen a lot of headlines near the end of February with the U.S. Supreme Court striking down the IEEPA measures. And on the same day, the U.S. administration immediately reimposed new Section 122 tariffs. But the good news was for Canada, throughout, all of these headwinds, the trade backdrop really hasn't changed, and that's because the one thing that we kept highlighting, which were the CUSMA exemptions. So those did continue to hold against new U.S. tariffs, and that is really the reason, going forward as well. We kind of don't improve, there are a lot of improvements in Canada's trade and tariff backdrop, but neither do we expect a lot of deterioration.
Okay. We had been exporting a lot of gold over the last year. The UK was a big buyer of that, but that dropped off at the start of this year as well. Any reason for that?
Right. I think that's just tied to just really volatile, gold pricing, which is kind of reflecting the uncertainty in the economics and geopolitics that we're seeing today, kind of reflected in global demand for safe assets. So if it doesn't, moving forward, the conflict in the Middle East, at least, in the near term, does look like to be persisting. And a lot of that is, again, reflected in oil price fluctuation as well. That means a lot more volatility, perhaps, in Canadian trade from that regard as well, specifically, like you said, with that one trade partner, the UK.
The wild card in this will be, of course, as you refer to, the renegotiation of the CUSMA trade agreement, which we expect to hear more about in the summer. How are you factoring that in right now to any outlook you're doing?
Right. So the CUSMA review process, there are a couple of pathways how that could essentially pan out. So our current estimation is still kind of, at the bare minimum, we do expect any exemption currently the U.S. has given to Canada related to the free trade agreement will continue to hold throughout the period of the review or the renegotiations. And the reason that we expect that is just because, frankly, while given what happened near the end of February, again, U.S. imposed new tariffs. And again, the CUSMA exemptions were kind of preserved. So what does that tell us? So that was telling us essentially that, this free trade agreement is mutually beneficial for businesses on both sides of the border, and especially for those that are in the 22 U.S. states where Canada remained the largest import source of in the year of 2025. So it's incredibly beneficial in terms of lowering costs for U.S. importers, which is, again, why we do expect they will continue to be preserved.
Okay, let's talk a moment for the Bank of Canada, or about the Bank of Canada. A lot of moving parts. We don't know how long the oil shock will last, depending on the war in the Middle East. We have the trade numbers, which you refer to, might not be as bad as they look, because some of that is because they're changing models for the cars. So what do you expect from the next meeting for the Bank of Canada?
Well, the decision itself should be a pretty consensus by this point, which is, we do expect a hold from the Bank of Canada, particularly perhaps amidst a really sort of chaotic and volatile global sort of economic and geopolitical backdrop to send a message of stability, perhaps. But, the flip side of that is the fact that us, alongside the Bank of Canada, simply do not have a lot of sort of great insights in terms of the scope, the duration, and the details of eventually how long this oil price will last. And according to Bank of Canada Governor Sharon Kazicki's speech about a couple of weeks ago, very timely, sort of addressing, how the bank would respond if it were to a supply shock to the economy, which is what it's seeing right now. There's a lot of different playing parts. Duration is the key consideration. So if the supply shock were to be pretty short-lived, then that typically invites a quote-unquote look-through response from the central bank, which is to say that, they simply won't react. And if the supply shock, in this case, the oil price shock, were to persist longer, that it does warrant a policy response, then the direction of that response, either a hike or a cut, is also open for sort of discussion and analysis. All that is to say that at this juncture is too premature for us, and perhaps, from the central bank's perspective, to, just respond. And there is really no need for them to be rushing to respond. For next week's meeting, what we do expect from them is for them to acknowledge that the risks are there, that higher oil prices could persist for longer, pushing inflation higher while hurting sort of consumer demand for non-energy goods and services, but without really sort of detailing any of either the direction or if they were to, have a policy response or not.
Got it. Claire Fan, thanks for joining us. Appreciate your time on this.
Thanks, Morella.
Coming up, what this week's market moves tell us about how investors will react to some of the geopolitical tension. Back in a moment. North American markets trending lower as that war in Iran triggers what some analysts are calling the biggest oil supply shock in history. Many warning that the conflict could be the start of a much deeper market crisis. Let's go to David Burrows on this, Chairman and CIO of Barometer Capital Management. David, thanks for joining us today.
Happy to be here, Marla.
If investors are looking for some insight, what would be the lesson to be learned from the last 2 weeks?
Look, there's a few takeaways. The first thing is, markets are remarkably intelligent. Information finds its way into the market generally long before you know why it's happening. We know so far, really since the beginning of the year, we've seen strength in energy, But we've also seen strength in defensives, utilities and consumer staples, which has not been the case, over the last couple of years. So market was seeing something coming. And I think that we're in that place where there are just more uncertainties today than there have been over the last 2 years. It happens to be coming at a time when, in an election year, it tends to be that February, March are tricky periods. You're coming up to a midterm election in the fall. Seasonally, there can be some softness after the first couple of months of the year. And so it's all coming together. Now, when we look at it against the backdrop of the fact that the U.S. stock market has been lagging internationally for 18 months, it's not as though the U.S. market has been leadership coming into this. The long-established leadership in technology has been waning over the last 8 months as other groups have sort of taken the baton. So money has been in motion. And when you have an uncertainty like this, it makes some buyers step back and maybe a few more sellers step forward, and the calculus changes.
Okay.
So we've been watching breadth in the market, which has been narrowing. And when breadth is narrowing, you don't know how long it's going to go on for. But what looks like leadership today can be the next, item for sale. So we just sort of step aside from any purchases. We make sure that we're watching our exit prices, our stop losses. And the most important thing is not to rationalize away market weakness, is to take it seriously and manage your position accordingly.
Okay, so given that, are you holding on to cash? And what would be your strategy moving forward if this conflict continues past a month or 6 weeks?
Yeah, so because of what the market has been doing, energy would be the biggest weight across our portfolios, and then behind that, industrials. And all of that has been hanging in very well. On the other hand, technology's been waning for several months, so I think we're about a 6% weight in technology. And financials have been under pressure, which had been good, strong leadership in the market over the last almost 3 years. So our positions have come down there. So we're about 20% cash, which is obviously a larger weight than we would tend to have. And it's not that we think that it's going to be there a long time sitting in cash, but it gives us optionality. We don't buy a falling market. We wait to see things turn. Generally, when things start to turn, you've got time. But the cash gives you flexibility.
Okay, so are there stocks you are keeping a close eye on to pick up when you see the tide beginning to turn?
That's a great question. I mean, that is probably the most important takeaway for investors in a market like this, is when the market's weak, okay, maybe you're not buying things, but you're building your list. You're building your farm team, things you'd like to own if things started to act a little better in the backdrop. Remember, 70% of return is getting the market right and getting the sectoral themes right, the leadership. So a couple things stand out. First of all, agricultural commodities are improving. They're joining the commodity bull market. And that's not, hurt by the rise in fertilizer prices. So ag companies are one area that's interesting. Certainly, if you look at equipment, Caterpillar's been a leader for quite some time, and Deere's been behaving pretty well. So things like Nutrien are interesting. On the other side, with some of the issues around credit and the real estate market, the consumer to us is kind of a no-go. And anything that is sort of consumer discretionary related, we're staying away from. So energy is, I think, an important sector, and I don't think it's just driven by the fact that we've had this spike in oil. We think this has been coming for a while. We're continuing to build a list of things we'd like to own in the metals and the precious metals. We came out of many positions in January just because things really spiked. And we think that there's some maybe more correction to take place, but there's going to be a second opportunity for another leg higher there. And that certainly doesn't get hurt by conflict. That increases the demand over time.
Okay.
And again, we'll keep on watching the financials for opportunity there. But that's one group that has been weaker. The one area that stands out as strength is some of the regional banks in the U.S.
Okay. Got it. I got to leave it there,
Pick your
David.
spots.
Great. Thank you for joining us. Appreciate your time on this. Thanks, David.
Thanks, Morella.
Coming up, Canadian space tech company MDA Space just debuted in New York. More from the CEO, Mike Greenley, when we come back. Canadian space tech company MDA Space debuted in New York today, officially entering the U.S. stock market with an IPO announced days earlier. To discuss the details of that move, we were joined by Mike Greenley, CEO of MDA Space.
Lots of interest in the space sector in the United States market. There's a lot of space companies in the U.S. The space market is expanding rapidly globally, and we're a strong part of that. Within the space market, you have a wide range of companies. Some of them are startups. They're pre-profit. Whereas in our case, we're a 57-year-old company. We've delivered technology into over 450 missions during those 57 years. We have strong growth, strong persistent profitability, strong cash generation. So we're quite an attractive space stock in this community.
And why did you feel it was important that you moved down into the NYSE and not, like, say, the NASDAQ and move down to the States in general?
Yeah, I think whether it was NASDAQ or NYSE, there's not a lot of difference there. We just picked NYSE for, just a series of small reasons. But it's in terms of why generally, it's really to get access to the U.S. investor. There are more space companies in the United States in the capital markets. As a result of that, there are more investors that are aware of the space economy, of space companies, the competitive dynamics, what the real growth opportunities are. As a result of that, folks are, giving higher valuations. They're willing to invest and really see the potential in space companies. And so it makes sense for us to be a part of that. We had a decent amount of U.S. investors as it was, but it's still a bit of a limit for people when you're only traded on the Toronto Stock Exchange for them to easily invest in you. And we want the full capability of the space investment community to be able to easily invest in us, which caused us to make this move.
All right, there's virtually no discount on the share price. Did you think about that before going public with it?
Oh, we certainly considered how much popularity we would have, and if a strong discount was going to be required. In the end, due to the strong popularity in the stock, the oversubscription that you mentioned multiple times, oversubscribed, we were able to really focus. We only put out a limited capital raise on this at $300 million. We were very intentional about this, very disciplined. We did not want to intentionally dilute our existing investor base very much at all, and so this is going to cause like a 8 to 9% dilution type of a thing, and as a result of that, that'll be regained quickly with the amount of enthusiasm that is seen around us, and it's provided a very successful entry into the U.S. markets.
Why was it important to cap it at that and not dilute the investors that are already there?
Just because we didn't really need the capital right now. We wanted to raise some capital that allows us to be able to enter the market more efficiently. It encourages banks to pick up coverage of us, and we would like more coverage of our stock from the U.S. banks. We will succeed in that as a result of this maneuver. Having a small amount of capital can be helpful just to further strengthen the balance sheet. We have about $100 million right now on our revolver, our line of credit. We'll pay that back quick. Have a couple $100 million in the bank. So we're in a very, very strong position from a balance sheet perspective, which will give us a foundation to be able to, consider acquisitions as we move forward into the future. That's another benefit of the U.S. stock, is that we're able to transact when we consider acquisitions using cash, as we have done in the past, and or using stock in U.S. stock.
All right. Now, the first day is the fun day. It's the exciting day, ringing the bell and everything. Then you have to come back for day two. What's the focus? Who do you see as your competition? Is it SpaceX, or do you see yourself working with them? And how do you see? What do you see as your next step?
Yeah, for us, it'll be to continue to build our relationships with the U.S. investors. That's really happened well as a result of this U.S. IPO opportunity. The large majority of the investors that have been participated in this equity raise round have been U.S. investors. A number of those have been long-only investors. So nice, stable U.S. investors that really appreciate space stocks. And so that's been excellent for us. We'll continue to nurture those relationships, introduce ourselves to more investors, participate in the various conferences and forums that exist down throughout the United States, and engage this investor community moving forward. And that's what we'll do. Meanwhile, back at the ranch, we will continue to operate and expand the business globally. And we have a strong organic growth path ahead of us. We have a $40 billion pipeline of opportunity to pursue over the next 5 years. So we'll be busy engaging with that, looking for our next round of orders. While strategically, we consider acquisitions in the U.S. or Europe to be able to cause ourselves to further expand inorganically as we go through the next couple of years.
And so but just go back, and SpaceX, do you see yourself working with them? Do you see them as competition? And are you
on SpaceX? We work with SpaceX for launch. For certainly when we contract for launch, we often use SpaceX for that partnership. In terms of competing directly with SpaceX, I think some of our customers, you would say, compete with SpaceX. We have one of the world-leading digital communication satellites in our MDA Aurora product. We've just completed a new factory in Montreal, which will have the capacity this year to start producing 2 satellites per day, 400 satellites per year in high-volume production. We'll be selling those satellites to customers around the world that need to build broadband data networks to provide internet-like data services globally, and also for direct-to-device communication networks to talk directly from satellite to cell phone. Those networks will, in many cases, compete with SpaceX's networks. So we're enabling those network providers to have the latest technologies produced in high-volume manufacturing globally to be able to win that competition.
And I just want to sneak in one last question. 6 decades almost in Canada. Are you going to stay headquartered in Canada? And you talked about acquisitions. Is there any chance that you might be acquired?
We will stay headquartered in Canada. I think that the Canada Investment Act would have a lot to say about us ever being acquired. We are generally viewed as a strong, important asset in Canada with the new defense investment strategy, clearly identifying space as a sovereign capability area for defense in Canada, with Canada wanting to produce its space solutions in space in partnership with Canadian industry. All of those factors would work together to keep us as a Canadian headquartered company. But we will continue to expand globally and have delivery and, in some cases, manufacturing capability in other countries, so that we can build them some sovereign assets as well for their space interests.
Mike Greenlee is CEO of MDA Space. Up next, the closing bells on Bay Street and Wall Street. Here are the closing bells for the end of the trading day. At the NASDAQ, KLA Corporation, celebrating that company's 50th year in business. For New York, Vulcan Materials, honoring the company's nearly 70 years on the New York Stock Exchange. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The Middle East conflict still weighing heavily on the North American markets. People are unclear how long this will last. The TSX Composite dropping another 0.8 of 1%. That's a 279-point drop for the TSX. The S&P 500 losing over 100 points. It's down 1.5%. And the NASDAQ, a 400-plus point drop. It's down 1.8% today. Let's get to the movers in Toronto. Go Easy, a subprime lender, sliding again today. So it's down 76% over the last year. Today, down another almost 14%, taking the stock price to $35.02. Let's go to Labrador Iron Ore. It lost 6.4% or $1.94 per share, taking the share price to $28.47. Bausch Health, which does seem to move around quite a bit, dropping 6.5% today, taking the share price to $6.89. In the green today, we have Nutrien. Nutrien is up over 6%. Fertilizer shipments, of course, are stalled in the Strait of Hormuz off the Iranian coast. And so that is moving some of the fertilizer stocks up today, including Methanex. It's a gainer on the day, almost 9% up, $6.46 move to 79.06. And then NFI Group gaining today 6.6% on an earnings beat. The company, which makes buses, has a $13 billion backlog as well, so investors are liking that. Descartes, also a gainer today, up 4.5%. That's a $4.29 move per share. Let's get to movers south of the border. Bloomberg senior equities reporter Bailey Lipschultz joins us now with that. Bailey, which stocks are benefiting from this surge in oil?
Yeah, we're seeing a number of companies in the energy ecosystem rallying. I want to call out some of the companies that are either drilling or helping transport it. So looking at the likes of Chevron, Exxon, APA, you name it, all leading in terms of performance in the S&P 500. As you can see, Chevron doing nothing but really moving up and to the right. Obviously, the questions are, how long does the war last? What are the ultimate knock-on effects? But we are seeing a big boost for those U.S. companies, those U.S. titans who not only have the capabilities to drill, but also have the ability to kind of own the entire ecosystem and really dominate by sheer size. So that's why you're seeing some of the bigger performers outperforming relative to smaller peers. Same thing you could say with ExxonMobil when you look at really how it's been following through in the last few weeks. It really is quite breathtaking. But again, it will be interesting to see and to keep tracking how some of these stocks mirror the movement that we do see in oil. Again, when you have Brent crude closing above $100, we do have the U.S. traded oil trading around that spot. So wanting to keep an eye on how that ultimately shapes up and how that has any impact in terms of knock-on effects.
Okay, let's get to SpaceX. I know they plan an IPO for the summer. Investors are frantic to get their hands on a piece of it. And Bailey, a lot of them are taking some risk to do that. Tell us about it.
Yeah, I put out a story this morning, or I guess yesterday evening, in terms of when it was published, but looking at these things called special purpose vehicles, we call them SPVs. It's basically a way for investors to bet on a company without actually owning the underlying firms. So if you think about it, the cleanest way to do that, they call it a co-invest or a clean SPV. A group of investors pool their capital under one entity that invests directly in the company. Though we have seen iterations where they're layered, so different people selling chunks of SPVs and charging fees. It's really just a feeding frenzy as it relates to SpaceX, OpenAI, Anduril, Anthropic, some of the hottest names because there are so few shares available for trading or even trying to get access to it. And so many investors are demanding or want to have access to them. We really have seen this boom. The SPV market over the last 4 years or 5 years, depending when you slice the data, up more than 11 times. So we're talking about a multi-billion-dollar industry.
Wow. Okay. We do have to leave it there, Bailey, but thanks for that. Appreciate it. Up next, markets swimming in a bit of blood today as crude prices continue to move up with no clear end in sight to the conflict in Iran. A new comment from the new Ayatollah. Back in a moment. North American markets are in the red again today. Oil hovering just under the $100 mark, U.S., of course, a barrel. And the new Ayatollah in Iran saying he's determined to keep the Strait of Hormuz closed. All right, let's bring in our next guest. He joins us now, Adam Johnson. Adam, have you pivoted at all since the start of the conflict as far as your investment strategy goes? And if it continues, are you going to pivot anymore?
No. We've seen these types of oil spikes before, Morella. And the lesson that we've always learned from that is do nothing. In fact, do as little as possible at moments like this. Sure, if some of the names that you like are down considerably and nothing has changed, they're simply down with the market. And if you actually have some cash to deploy, fine, deploy it. But I have been doing very little. Yes, some of my clients have brought in additional money and said, do your thing, deploy the capital as you see fit. But I'm certainly not changing any of the picks because none of what's happening right now in Iran and the Middle East in general has any impact on the names that I'm buying. It doesn't change what's happening with AI or with data centers. It's not a market story aside from oil. Yes, oil is a market story. But in terms of the investment themes that actually are driving corporate earnings in the growth companies that I invest in, no, this is not relevant.
Okay, so software stocks are of interest to you now that they're, I guess, beaten down and come down in valuation. Are you, or how are you, I guess, determining which ones you want to step into?
Well, one of the concepts that has served me well over time is best in breed. If you buy a best in breed company, generally speaking, you're going to be okay. And in terms of best in breed names, I would look at Salesforce and ServiceNow. In fact, these two companies, software companies that were down 45, 50% on the assumption that AI was going to eliminate their businesses. These companies have started to rebound. In fact, they're up 10, 15% from the lows. You can see just on that chart, ServiceNow starting to bounce. Okay, fine, down over the past couple of days. But I think that's a very powerful concept. We've taken these names down so far on the absurd assumption that somehow AI is going to eliminate these big software companies. I mean, how naive, Morella. Imagine if you thought that you could go to ChatGPT. Let's say you run IT for Delta Airlines, and you say, okay, ChatGPT, I'd like you to reinvent my network. I'd like you to reinvent scheduling, and not just for the airplanes, but for all the passengers and all the crews. And while you're at it, why don't you figure out how to maximize my fuel usage and buy it more effectively? I mean, how naive, how absurd to think that a few keystrokes or plain English into a ChatGPT kind of agent will suddenly rewrite software programs that have taken years to hone and perfect. So in fact, a lot of the software companies like ServiceNow and Salesforce that have been decimated by AI angst are not AI casualties. As it turns out, they are AI use cases. And that's something we learned from Oracle in their earnings a couple of days ago. So yes, I'm a buyer of software stocks, especially after all the selling.
Okay, you mentioned you're not pivoting your strategy with regards to energy and oil going the way it is these days. But walk us through what you see the fallout of continued shortage of crude, knowing that there is a plan to tap reserves, but we don't know how long the conflict will last.
Yeah, we can tap reserves, and that by definition will last for a period of time, but not indefinitely. What I am noticing, and I say this as a former oil trader who spent a lot of years looking at oil in very creative ways, the companies and countries that produce oil are getting very creative. Just start with the Saudis. So the Saudis have a pipeline that runs to the Red Sea. Obviously, that's the opposite direction of the Persian Gulf to be farther away from Iran. They built this pipeline many years ago for just this sort of event where the Strait of Hormuz got shut off and they couldn't get the tankers out. Now, that pipeline won't get all of their production out. They produce 10 to 12 million barrels a day. They've been running on the lower end of that. But that pipeline, which has been pumping about 700,000 barrels a day, they can actually get that up to 4 million. So, okay, they were producing 10 and 10 was going out, but they can at least still get 4 out. So it's not like they're totally shut off. And we're seeing Venezuelan production come online. Every U.S. producer is throttling at full power because think about it. When oil is $90, every well in this country is profitable. I mean, you're even starting to make the Canadian oil sands. Remember those from, decades ago? Even those start to look profitable in the 90s. So my point is, if you have the ability to bring on that supply that hasn't been at market or you weren't pumping out of those wells because the price wasn't high enough, well, the price is now high enough and you are doing that. So the world is going to start getting very creative. I mean, we're even letting Russian barrels come onto the market and get sold into Europe that had previously been embargoed. So I think what's going to happen is there is going to be regime change. Ultimately, I think it'll buckle because they've been so decimated and the people are wanting to rise up against the regime. And I think the regime's days are numbered, and when the regime implodes, Iranian oil, 4 million barrels a day, will no longer be embargoed. I think we're going to find the world is awash in oil, and we certainly won't see $90 oil very long.
Got it. Adam Johnson is founder and author of Bullseye Brief. Thanks for joining us today.
Thank you.
All right, Adobe reporting their latest earnings right now. It's coming into the newsroom. Let's have a look at what is going on with the stock. So far, it is down in after-hours trading over 5, closer to 6% right now, and hovering there. Remember, this is a stock that has fallen 23% this year alone on AI disruption concerns. So what we're looking for is, from Adobe, an opportunity to prove that they're making money using the AI they are now trying to put into their products to make those products above and beyond. The high for the stock was $688. That was in November of 2021. And you can see the stock right now at $269 there on your left-hand side. Let's get to the first quarter results coming in. Earnings per share at $6.06 versus $5.08 year over year. The consensus by Bloomberg was $5.88, so a beat for Adobe there. Revenue coming in at $6.4 billion, 12% better than last year. The estimate had been 6.28, so they did beat in revenue. Subscription revenue coming in at 6.2, a 13% increase from last year. And the estimate had been 608. Product revenue coming in at $90 million. That's actually down over 5%. The estimate had been $78.6 million, so still a beat for them on that. Adobe sees second quarter revenue, this is key, coming in at $6.43 billion to $6.48 billion. The estimate had been on that low end at $6.43 billion. And they see second quarter adjusted earnings per share coming in at $5.80 to $5.85. And the estimate had been underneath that. So they'll beat that if they stay on course at $5.70. The CEO is going to resign after a successor is named. That is also the news coming today from Adobe. Up next is oil surges again today. It joins a club of commodities peaking in the first quarter. We'll get into that when we come back. Are we approaching a peak everything moment? With volatility surging in the first quarter of 2026, everything, as you know, from crude oil to Bitcoin have been making historic moves. Let's go to Mike McGlone, Senior Commodity Strategist with Bloomberg Intelligence on this. Mike, thanks for joining us. Run us through the peaks so far.
Well, hello, Meryl. I think the most significant one this week is crude oil, around 120, both Brent and WTI. Right now, Brent's around 100. That's a pretty significant peak. The high in 2008 was 130. This is a pretty extreme reason. Bitcoin got to near 100,000 early in the year, and that's back down to 70. Copper got to above 6. Now it's back down below 6. The yield on the U.S. Treasury bond, it got to near 5%. It's back down a little bit. And silver got above 100 and back down a little bit. And there's one key theme for all those market peaks in 1Q to be enduring and to be kind of a sell the opening on the year, buy the close, meaning heading lower by the year. And that's just a little bit of normalization, U.S. stock market volatility, and that's still the problem for me. It's still very low, 180-day volatility, and the NASDAQ S&P 500 still near almost a 10-year low.
Okay, let's talk about what comes. Does this signal, for example, other peaks?
Well, I think it's a signal for everything, but now we have a significant event going on. I mean, we've never had a closing of the Strait of Hormuz, and obviously that's been pressured by our president who wants lower energy prices. I think they're going to get them. But let's look at the foundation for this to happen. Is last year we had the best year for gold since 1979. That was a warning. Something's happening. And gold probably front ran this event. Also, we've had cryptocurrencies collapse. Cryptocurrencies led the way up, and they're leading the way down. So to me, this is the beginning of a year that's going to be very similar to 2008. You're seeing that with the spike in energy prices, and that's what really accelerated the recession in 2008. When crude oil pumped up to 150, the average price of a gallon of gas in this country got to near 4, and then everything collapsed. To me, that's what I'm worried about for the year end.
Okay, so that's what I was going to ask you is what is your take on what happens with oil? And I know reserves are coming, being tapped. We don't know how long the conflict continues. So give me your sort of estimation, best case scenario.
I'm looking at 2008 as an example. Crude oil peaked in July around 147. And the low was 32 in December. We just did that in natural gas in January. The high in natural gas, U.S. natural gas was 7. Yes, we had a very cold winter. But the front contract future right now is 3. It went from up 100% to down 15%. Just in the beginning of this week, crude oil was up 100% on the year. But one thing, remember, crude oil is it's its own worst enemy. It's the most autocorrelated commodity. When it spikes, it pressures that demand, it increases supply, and potentially tilts the world towards a global recession and an energy crisis. That's where we are right now. Question is how long it lasts. But I think this spark might be enduring. Even if the Strait opens up tomorrow, this spark is potentially enduring. Because remember, the rest of the world's facing curtailment of exports from the U.S. China's exporting pretty significant deflation. And the bottom line for everything is the U.S. stock market has to stay elevated. And all this volatility looks like it's starting to trickle over to the stock market. And that's your next recession if we get a little bit of reverse wealth effect.
Got it. Mike McClone, sir, got to leave it there. Mike's with Bloomberg Intelligence. Thanks for your time. The Strait of Hormuz has effectively been closed for about 2 weeks, not really entirely shut, but most of it. Not just a key shipping route for oil, but also natural gas and fertilizer. Arif Lalani joined us on this. He's a former Canadian ambassador, distinguished fellow at the Center for International Governance.
We just had the new leader of Iran give his first public address in which he raised the ante. He basically said he will keep the Straits of Hormuz closed. He will spread the retaliation to other centers. I think there was a bank hit in the Gulf. So I think the economic impact of what the United States and Israel initiated 10 days ago is just going to get larger, and it's not clear how the Americans disengage if you're looking at the news today.
Because the Iranians seem to have an advantage here. They have cheap little ships and mines and drones and missiles, and America has these multi-billion-dollar ships. So Iran can hurt them more in economic terms than the Americans can hurt them. I mean, in the Strait of Hormuz.
Well, I think what you're seeing really is a chain reaction of really large economic disruption. I mean, you have the price of oil, which everyone is speaking about, and you have the access to liquid natural gas, which is going to be really severely felt in parts of Asia. But you also have the disruption of cargo flights through Dubai and the Gulf, the movement of people through the major airlines. So all of this is going to be felt in the economy, including Canada and Canadian businesses that operate in the Gulf.
The new Iranian leader has not been apparently seen in public since he succeeded his father. That's according to the BBC. But he has already lost family members to attacks on the country.
Well, that's right. I mean, it's reported that, of course, his father was killed, but I think also members of his family, his siblings, I believe his wife as well. So, there was a lot of damage done. But the fact remains that today it's very hard to see, what has been achieved. The Iranian regime is largely intact. Some might argue that a younger, more hardline leader is in fact in power. The nuclear enrichment issue has not been addressed. Clearly, the ballistic missiles continue to fly, and there's been a major economic disruption for all of America's allies. So it's not a very good picture right now for the global economy.
Is it fair to say that America's Gulf allies in the region, or at least countries favorable to America, are disappointed and disenchanted that they have found themselves on the front line here?
Well, certainly this battle is being fought on the backs of the Gulf states and the millions of foreigners, Canadians included, who reside there. So, yes, I think there will certainly be a strategic adjustment in terms of the relationships with the United States when this war is finally concluded.
Talk to us a bit about the impact on the Canadian economy. I mean, higher oil prices generally good for us, not so great for us here in East Central Canada in the sense that we have to pay more for energy, but higher commodity prices generally seen as good for Canada.
Well, look, certain provinces are going to see some benefits. Clearly, the oil-producing provinces on the west, in Alberta, Saskatchewan, and on the east coast, Newfoundland, Labrador, are going to see increased revenue. But at the same time, we will have this lag effect on agriculture, on food supply, and even the price of oil and gas in Canada, because these will increase. So we're going to see a lag effect in a few months. In the medium term, there are some opportunities here for Canada as other countries look to diversify their sources for oil, gas, fertilizer. The challenge for Canada is we also don't have the capacity. We don't have the infrastructure to get enough of our resources off the continent. But I think this should accelerate that move for Canada.
Just give us a final piece of perspective. You have, as I said, a deep knowledge of the Middle East. Is this, I mean, in some ways, this fighting U.S. and Israel versus Iran feels like it's unprecedented in its impact. Certainly, the rapid way it's pushed up oil. Have we crossed into new territory here?
I think we have. I think it's unprecedented to unleash this kind of a direct military attack without a game plan. I think this is worse in terms of lack of strategic consideration than the American invasion of Iraq decades ago.
Wow, a bigger mistake than the 2003 invasion of Iraq?
Well, it would appear that way today. I mean, there doesn't seem to be a plan. The war aims and the objectives are not clear. The damage to American allies in terms of the economy is large. And it's not very clear how America claims victory. I'm sure President Trump will. But right now, no set of objectives that President Trump has laid out have been achieved.
I suppose maybe in Washington they felt they had Iran on the run. Syria, the Assad regime there was ousted, but maybe they've overplayed their hand.
It seems to me they've overplayed and they've miscalculated. You know, there's been a year of negotiations, for example, with Russia, and they continue to try and make a deal. With Iran, you know, there were a couple of rounds of talks, and then they unleashed sort of the largest military action since 2003, with really no strategy and no plan. So, you know, if you're looking at it today, it does look like a very heavy miscalculation.
Arif Lalani, former Canadian ambassador, distinguished fellow at the Center for International Governance Innovation. Coming up, Descartes Systems sees momentum after reporting a fourth quarter beat. Our conversation with the CEO when we come back. Descartes Systems reported a beat for its fourth quarter. They beat expectations across all key metrics and showing some early momentum in its AI strategy. We were joined today by Edward Ryan, the CEO of Descartes Systems.
In the early parts of the year, with all the tariff uncertainty and people weren't sure whether they should ship or not, that's largely gone away now, and the new tariff regime in the U.S. is a lot simpler for people to deal with. So that's been very good for us. Shipping's picked back up, and the number of transactions that we're processing gone right along with it. So that's been good for us. That's why you're seeing great numbers out of us. And then we had the other part of it where, we run the largest database of tariffs and duties and sanctioned parties in the world. And that's always been going well because people are trying to access that information on our network to try and figure out what to do. So that we had strong momentum there the whole year. Unfortunately, some of the tariff stuff at the beginning of the year slowed shipping down, but since then it's been last 2 quarters have been going great, and I expect that's going to continue.
And have you found that in some ways to be a bonus for you, the tariffs?
Oh yeah, I mean we operate the largest tariff and duty database in the world, largest sanctioned party database in the world. Most of the supply chain participants use our information to figure out what they're going to do, where they're going to ship it to and from. And every day those tariffs are changing. There's more reason for people to use our systems and help deal with the complexity that they're facing in the market. And that's been good for us all the way through.
And you're sitting on, I think, $356 million in cash and another undrawn $350 million in the credit facility. What are you looking to for the next little while with that money?
Well, we're a very acquisitive company. We always have been. with a lot of tech's been hit with AI concerns. We think it's a big tailwind for us and a big advantage for us over time. And I think you're going to see us continue to buy up assets in the space to take advantage of it.
And any particular any area you can talk about, or are you just kind of casting a wide net?
Well, yeah, we have a lot of stuff in the pipeline without naming names. I mean, some of the businesses we're in, all of the global trade intelligence business, it's about 20% of our business, is very attractive to us. Certainly, any network that competes with us in the logistics and supply chain space is something that we're very interested in. And our transportation management tools and supply chain visibility tools is a great space for us. There's a lot of assets there that we think in the long run might be a good fit for us. And then I guess finally the e-commerce space, where we've probably done 10 acquisitions over the past 7 or 8 years, and I think you'll see us continue to deploy more capital to buy things in that space, because the first ones went so well for us.
All right, and you called AI a tailwind for you. A lot of people were looking at AI as being a headwind for software. How are you incorporating it, and how do you see it as an advantage for you?
Well, first of all, people lump us in with enterprise software. I'd say we're probably more inter-enterprise software. We run something called the Global Logistics Network that processes transactions for our customers, and we think that gives us a proprietary set of data content that's going to be very valuable in the future to run AI routines against and agentic agents against, and it's going to allow us to provide a big opportunity for our customers to operate more efficiently and save money.
Now, you're running at about 15% of revenue, seat-based pricing. The agents, how are you going to work that all in together and grow it as the AI agents become more commonplace?
Well, it's 15% of our revenue. I think you might have said 50.
I did say 15. Sorry, I didn't enunciate. 15, right?
Yeah, it's 15% of our revenue. It's a minor part of our revenue. We'll probably end up changing that as agents come into the space. We're probably going to provide our customers with a lot of those agents, and we may change the pricing for that. But understand, even today, a customer pays a certain amount of money per month. They have a monthly minimum. It's not something I think that we're going to have material change in that, and we probably will change the pricing model away from users. But again, it's only 15% of our business, and I think over the next 5 years you'll see that change to something more like transactional pricing, or look at a bundled package for the size of their business. And I don't imagine that's going to be a big deal for us.
All right, and you reduced headcount by 7%. AI, more and more AI is coming in. Do you see larger numbers than that over the next little while, or are you actually going to grow staff in some ways?
We're going to we're getting savings already from AI, and we just keep putting that money back into we keep our employees and put our money back into putting more functionality out. And I think you'll see us continue to do that in the future. Whether we add because of it or not, I guess we'll see. But right now it's improved our efficiency quite a bit, and we haven't been using it to lay employees off. We've been using it to provide more functionality for the customers, and we think that's the right way to handle it.
And can you put a number on that, on the efficiency?
I probably shouldn't put a specific number on it, but it's significant. We're able to produce a lot more code right now and roll out functionality that 5 years ago might have taken us a year, and now we're talking a month or two to roll it out. And we have ideas, and they come to fruition much more quickly. We don't need as many developers to do it, so it's easier for us to do. We have more like product managers that are coming up with ideas, and they're able to do a lot of that work themselves. And so the nature of the work's changing a little bit, and I think that's a real positive for us, because we're able to do it much faster than we used to.
All right, and just one last question: the war in Iran and the impact it's having on oil and geopolitical tensions, is that having any kind of an impact on your company?
It's minor right now, but I think you're going to see it have more of an impact in the future. These things put a lot of pressure on our customers. It increases transit times, and people usually end up using our systems more than they did to prior to the war, to figure out what to do about it. These types of things have usually been a net benefit, and I suspect the same will happen here over the next couple of months. We'll see how long the war goes on for. Hopefully it's short-lived, but if it goes on longer, our customers have to deal with it, and they use our software to figure out what to do about it.
Edward Ryan is the CEO of Descartes Systems. Mark Carney closing in on a majority with another crossing of a member of parliament. But what do Canadians think about all these defections? We'll find out in just a moment. Following a recent trip to India, Japan, and Australia, the Prime Minister is on another trade mission, this time to Norway and the UK. We are joined by CTV's Jeremy Chiron on this.
Yet another trip for the Prime Minister. He'll make a stop today in Yellowknife before traveling abroad. That announcement, or that stop, is expected to be an announcement surrounding defense, some kind of defense announcement in terms of protecting the Arctic and northern regions of the country. We'll get more details later today. And then he embarks on a trip to Norway that will be also focused mostly on defense. The Prime Minister, while in Norway, is expected to observe a NATO exercise alongside the German Chancellor as well as the Norwegian Prime Minister. That is an exercise in enhancing NATO's Arctic capabilities, Arctic defense capabilities. One that only happens every couple of years, about 25,000 military members taking part in that exercise. While in Norway, he is also going to have a bilateral meeting with the Norwegian Prime Minister. They're expected to talk about a number of things, including foreign investment, clean energy, critical minerals, aerospace, and AI. He'll also spend time with the Nordic Five, the leaders of Iceland, Denmark, Sweden, Finland, and of course, Norway. They'll talk about a number of things, including trade and bolstering cooperation in the Arctic. After his time in Norway, Andy, he's also going to make a stop in London, in the United Kingdom. He will meet with Keir Starmer at 10 Downing Street. They are expected to talk about the situation in the Middle East, as well as the situation in Ukraine, two conflicts, global conflicts, where the UK and Canada are very they see eye to eye. They have very similar positions on how to move forward and how to provide support. That will be the end of the Prime Minister's official itinerary. But he is staying in Europe on personal time, we're told by the Prime Minister's office, until March 22nd.
CTV's Jeremy Chiron reporting. Mark Carney's government, 2 seats, as you know, short of a majority after yet another MP defected to the Liberals. A new survey by the Angus Reid Institute shows what Canadians think about these moves. Sachi Curl is president of the Angus Reid Institute and joins us on this now. Thanks for your time. Canadians are pretty tough, I think, on this issue. A majority say they shouldn't be allowed to finish their term. Can you expand on that?
That's right. So the thing about floor crossings is it's a zero-sum game. And so when you ask Canadians, how do you feel about this particular floor crossing or that particular floor crossing, it really depends on who the benefactor is, who benefits from that floor crossing, and then whether Canadians support that party or not. Case in point, about 8 years ago, when we asked about Liberals crossing over to the Conservative Party, at that time, Conservatives were more likely to be like, yeah, this is great. We should have floor crossings all the time. I'm paraphrasing a little bit. But this time around, with 3 Conservative MPs having crossed over to the Liberals and now a 4th NDP MP having crossed over, you see that there is a lot more happiness or a lot more acceptance or support for this type of thing among past Liberal voters than there are among past Conservative voters. The NDP factor is a new one. We'll have to see how that looks. But overall, whether or not people think that floor crossings should be allowed or shouldn't be, the one thing where they do provide some level of direction in terms of public opinion is in saying, look, you can't just cross the floor and then expect to serve out your term as an MP under a new party banner without any further action or repercussion. The problem, of course, is that there isn't a lot of consensus over what that action should be. So you've got some folks saying, look, people should, if you want to cross the floor, if you're an MP that wants to cross the floor, then you should have to resign your seat and fight in a by-election. Yeah. Others say if you really want to cross the floor, fine, sit as an independent for the remainder of your term and then run for the party that you want to change to and do that for re-election. And others say, look, it just shouldn't be allowed at all. So only about 1 in 4, 25% of Canadians say, it's fine to have the situation that we've seen unfold now for a fourth time as of yesterday, where an MP for one party moves over to the caucus of another party, sits as a member of that party, votes as a member of that party, represents their constituency as a member of that party, with no further action or opportunity for constituents to have a say.
Yeah, I guess it matters on whether the voters voted for the person or the platform, or both, right? Because clearly some of them aligned with the party that they were part of. Did they weigh in at all in the survey on if a majority gets achieved by defection? Did you hear anything on that?
Yeah, there's less, I think, support for, based on the data that we've seen. There's more of a red flag or pushback around the idea of the Liberals obtaining their majority by way of floor crossing. Floor crossing is always going to happen, and we've seen it certainly play out, Morella, over the last decade or so as we've dealt with minority parliaments one after the other. But it's the idea that the Liberals might obtain their majority by ostensibly pulling sitting MPs over. Of course, they still have to fight in those 3 by-elections coming up. But let's face it, 2 of those by-elections in the GTA, in the Greater Toronto area, that the Liberals are having to refight for and try to reclaim those seats that were vacated by sitting Liberal MPs, Chrystia Freeland and Bill Blair. Those are safe seats. So ultimately, yes, it's not a foregone conclusion, but unless you see some sort of all-in revolt on the ground in those ridings affected by the by-elections, where somehow the Liberals lose all 3 of them, which is unlikely to happen. They're probably going to take 2 of 3 of them for sure. The Liberals, in effect, de facto, now have their majority. And there is a sense among Canadians, you do see some consensus there, that, obtaining that majority through not entirely democratic means, i.e. not every single MP that became a Liberal fought and ran as a Liberal and won as a Liberal, is something that doesn't sit quite right with a significant number.
Yeah, you can understand that. Saji Curl, thanks for joining us. Appreciate it.
Thanks for having me.
Coming up, hot picks. We'll zero in on 3 plays in retail when we come back. Time now for hot picks, and we zeroed in on 3 plays in retail. We kick things off with Nike. Our guest, David Schwartz of Morningstar, says he believes the company can turn around from a low trading period using their strong connection to global sports, teams, athletes, and events.
The company's in the midst of a turnaround, but I think the stock is quite undervalued. My fair value estimate is $102, which is obviously well above where it is right now. The stock has really been weak. Even lately, it's had a big downturn. And that's just because people don't have clarity on when a turnaround might happen. But I do think that Nike is making progress. The company is working on improving its relationships with retailers like Dick's Sporting Goods and Foot Locker, and working on its own direct-to-consumer channels as well. Now, Nike has struggled in China, and that's also another major concern. I think it's possible that we're going to see a major restructuring in China at some point. That could be a positive catalyst for the stock. It's also, I think, possible that Nike will sell Converse, which is a very small part of the business, but it's been a real drag on earnings because it's been struggling badly. Nike recently announced significant layoffs at Converse, which suggests that it's no longer really supporting the brand. Nike also has a lot of new products coming out. The World Cup is obviously coming up in a few months. That's a huge marketing event for Nike. Nike will be all over the place at the World Cup. It's also going to be an opportunity for Nike to launch a number of new products. So Elliott Hill, the CEO, has been in place now for about 1.5 years. And I think we're going to start to see progress in the next fiscal year. But right now, investors have really have a negative view of the company.
Just remind, Converse is an old venerable brand, but it's just lost its way, has it?
Yeah, I mean, Converse is a very small percentage of Nike's total revenues. In the past, it was a growth driver, but recently it's had very poor results. It's not something that Nike has put a lot of marketing dollars behind, and there isn't a lot of new products coming out. Nike has said in the past that it wants to keep Converse, but there's been a lot of speculation lately that is probably being set up for a sale.
Your next idea is Canadian Gildan Activewear, a generic play on T-shirts and underwear.
Yeah, Gildan's primary business is printwear, which is mostly blank shirts, which are sold into the printwear market. But recently, Gildan acquired Hanes Brands, which essentially doubled the size of the company. And this will get Gildan much more heavily into retail basics because Hanes brings some leading brands in categories like socks and men's underwear. The Hanes brand is obviously very well known, much better known than Gildan in North America. And so this will give Gildan an opportunity now to expand away from sort of its core market into more of a retail branded business. Some investors have been concerned about that because historically Gildan hasn't done that very well in that market. But Hanes was really on its way, I think, towards a turnaround when Gildan acquired it. And I think Gildan really paid a very good price for it. My fair value estimates are $128 Canadian on the Toronto shares and $93 on the New York shares for Gildan. And so I think it's actually quite undervalued, although it has had a bit of a run. But Gildan bought Hanes at a very low price, I believe. And so I think it's going to benefit from that very efficient acquisition over time.
And then finally, VF, apparel, footwear. Can you remind us what the big brands there are and why you like this stock?
Yeah, VF is primarily a shoe company, but it does a number of things. Its biggest brands are Vans, the North Face, and Timberland. It really has exposure to the apparel and footwear areas of active with Vans and some other brands, and with the outdoor category with Timberland and the North Face. In recent years, VF has really fallen on hard times. It was once a very successful company, especially when Vans was in its real growth phase. But Vans has struggled over the last few years, and that's really caused a huge decline in VF stock price. The North Face has been healthier and is still doing pretty well, but there's work to do there as well. I think VF is extremely undervalued. My fair value estimate on it is close to $40 per share. The CEO, Bracken Darrell, is similar to what I talked about with Nike, is pursuing a turnaround that is taking time, and investors just are unsure when it's going to really happen. But I think that progress is being made. I think that what will happen here is that Vans will stabilize at some point, and people will recognize that VF has a lot of value. The company has also improved its balance sheet considerably. It has sold some brands, including Supreme and Dickies, which it used to own, which has allowed it to reduce debt, which in the past has been a major problem. And so it can focus on its brands that really are the core of the business, which are the North Face, Vans, and Timberland.
David Schwartz, Senior Equity Analyst, Consumer Equity Research at Morningstar. All right, here's how we ended the day on Bay Street and Wall Street. A streak of red again today with the conflict in Iran continuing, and the new Ayatollah in Iran saying the continued pressure on the Strait of Hormuz to stay closed is what he sees as the right thing to do. The TSX Composite down 0.8% today, a 279-point drop. The S&P dropping over 100 points, that's 1.5%, and the NASDAQ dropping 400 points today, close to 2%, so 1.8% there. I also want to get to the price of oil, of course, which everyone has been watching for the last almost 2 weeks. West Texas Intermediate creeping back up to that $100 mark per barrel. It's up about 10.5% today at $96 US a barrel, up 45% over the year. Also want to share Adobe, which reported results after hours, and you can see it's trading down. They're trying to prove to investors that they're using AI within the company to improve the product. But so far, investors have concerns that AI will take over the services that Adobe provides. Thanks for joining us today on The Close. We'll see you back here again tomorrow.